All right, so we made some really good progress on weighted average cost of capital in our last class. What we want to do now is finish up the notes on that. There's some really interesting things related to cost of capital, and then we want to actually apply it. So we want to look at ways that we can use cost of capital to assess whether management's doing a good job or not. Now you notice with costs of capital for equity capital, we needed a beta for the company, and to get the beta for a company, you need a stock price. Well, firms that are not publicly traded, like HEB or USAA, firms that don't have a stock price, can you do the same thing for them? So at USAA, I was actually responsible for coming up with USAA's cost of equity. We filed it with the regulators when we were pricing our products. And so I had to come up with a beta for USAA even though we did not have a stock price. And so what I would do I would find similar companies. I found 11 companies that were very similar to USAA. I calculated their betas just like we did it up above, figure out the betas for their companies, and then adjusted it for the leverage of the firm. USAA was a far better capitalized or had a lot more net worth relative to its assets than these other companies. So that would bring our beta down some. Remember, the third input for beta is financial leverage. Firms with high debt or high financial leverage have high betas, and those with low financial leverage have low betas. So I would take these competitors, 11 competitors, get their debt to equity, look at how leveraged they were, and then I would adjust USA's beta down for that. So it's actually possible to come up with a cost of capital even for non-publicly traded companies, assuming you can find similar companies out there. So when a firm uses debt, we're going to talk about this a lot more a little bit later. Actually, one of the big questions on the final is understanding this concept that we'll see when we talk about maximizing the value of the firm by maximizing the use of debt. But debt makes the firm more risky. So we actually can say that the levered beta of the firm, levered beta means the beta of the firm giving all the debt that it has. The levered beta of the firm equals the unlevered beta of the firm times 1 plus the tax rate times debt over equity. That gives you, so if you want to take a firm that has no debt, you want to figure out what its beta would be if they brought on debt, then use this formula. And again, we take into consideration that the debt is tax deductible. I can't derive this formula for you. We won't do that in this class. You don't need to ever memorize this formula. This is one of those formulas, especially if you're not a finance major, you can just look it up. But even most finance majors look this up unless they have an exam pending on it. It's a formula. I forget sometimes where the parentheses go, so I usually look it up just to make sure I've got it. This is what I did with USAA, is I took all of its competitors and I calculated their unlevered beta, and then I took the unlevered betas of all USA's competitors and said this is what USA's beta would be if it had no debt, and then I adjusted it for USA's debt to equity. You're supposed to be using, when you have debt to equity, you're supposed to be using market values for debt, market values for equity. Most people are pretty sloppy on that. A lot of times people just use the book value. For debt, the book value of debt can be really quite different than the market value of debt. Equity is pretty volatile as well, but it's a much easier number to get. On the exams, I just give you the values and don't tell you if it's market value or book value, so you just use whatever values I give you. This is just something, especially if you're a finance major, this is just something to be aware of. The textbooks, they use market value. A lot of firms are pretty sloppy and just use book values. So you can also figure out the unlevered beta the other way around. So this is what I did for USA's competitors, is I took their beta as given because their beta is levered because they have debt. I divided by all these things to give me the unlevered beta, and then I took USA's numbers here and got our levered betas. So you can go either direction. So one thing that we can do with this is to try to estimate the value of non-publicly firms, just like I mentioned. with USA, let me just tell you, it's a little tricky because insurance companies, they have debt, but they also have what's called reserves. And so you have to decide, are you just going to stick with just pure debt, or do you bring in other liabilities? So that's a little tough in some industries. For a lot of industries, it's fairly straightforward. For some others, it's not. So when you're talking about levered versus unlevered betas, there's some debate as to exactly what you count as debt. And so then you just plug in whatever beta you come up with the formula we've already talked about. So you've already seen that. And so we've already covered this, but just real quick, we're talking about the weighted average cost of capital, or WACC. It's the formula that you use to discount cash flows. So your team is doing a project called a capital budgeting project. I gave you a discount rate. I said just use 5%. That's fine. But in reality, you would use the firm's weighted average cost of capital. So how do you do that? Well, most textbooks say that each project should have its own cost of capital. So if you're doing a project, some marketing campaign or something, you try to find another firm that has those same risk characteristics of the project, and you use that. We call these proxies or pure play betas. I do not know firms that go through that much complexity unless it's a really, really major project. First of all, it's extremely time consuming, and secondly, it's incredibly subjective. And so you'll have people playing games because they want their cost of capital as low as possible because that would make their project look better. So I think a better approach is just, first of all, just be conservative in your estimates. Incorporate, as we talked about, sensitivity analysis, except for the most major projects. If you're trying to merge with another firm, something that's really huge, that's when getting the beta calculation exactly right is important. And then the question is, well, do I assume my project is going to be all debt or all equity? If you remember the formula, we took the cost of capital as cost of debt times 1 minus the tax rate times debt over equity. But you might say, well, my project is going to use all debt, or my project is going to use all equity. Well, we don't have a debt to equity ratio for each project. We have one for the overall firm. What is their target capital structure? We're going to talk a little bit in a few more classes what we mean by target capital structure. What should the firm be shooting for? But whatever that is, you want to use that for all projects. You don't want some projects to say, hey, we're going to do everything with debt, and some projects say we're going to do everything with equity. You just assume the firm has a target capital structure, and that will apply to all projects. So here's the formula. I would know this formula. So I said levered beta, unlevered beta. That formula, you don't necessarily memorize that one. I would definitely know this formula, even if you're not a finance major. This is just one of those really famous formulas. It's somewhat like knowing how to do debits and credits in accounting. It's just one of those really, really critical things to understand as a business major. All right, we already did the WACC examples, and you have the Excel application, so I'll put a due date on that one here after, you know, I'll have 6 and 7 due at this pretty close at the same time because it's a similar project, but I'll let you know on that. All right, so that's cost of capital. So what can we do with cost of capital? So the next thing we want to look at is economic value added. It's one of the most important concepts in finance. Very, very highly used. When I was at UTSA, we used economic value added. I don't think they do now. They changed CEOs here recently. Wayne Peacock is more of a finance person than Stuart Parker was, the previous CEO, and before Stuart Parker was Joe Robles. The CEO when I was there was mainly Bob Davis and then Joe Robles. Bob Davis was a huge EVA, economic value added person. He drove USA to make sure we used EVA in assessing our performance. There is a function in Bloomberg. If you want to get this for your company, you just type in the ticker of your company, hit the F8 function, and type the letters WACC. You might remember, you probably don't, but you might remember when I gave you the Walmart Excel spreadsheet for you to do your project one, EVA was one of the graphs I gave you, but we didn't use EVA because we hadn't talked about it yet. But you might go back and want to look at your firm. There have been studies of EVA with stock investors and major portfolio managers, and the number one thing they use, they say, for evaluating companies is economic value added. So it's a very popular approach. So what do we do with economic value added? Well, what we're going to do is we're going to compare the weighted average cost of the firm. That's their required return, and it's adjusted for risk. It's retired return on capital, and we're going to compare that to their actual return on capital. That's the return they actually get. So what they need to make versus what they actually make. And the EVA, or the EVA spread, is the difference between return on capital and their required return on capital. ROIC is a little tricky. We talked about return on equity in your project 1. Return on equity is just return on equity capital. Return on invested capital is return on both your debt and your equity capital. So it's a total return of the firm. And you want to see, if you make 8% there, but your cost of capital is 6%, you had a 2% EVA spread. And if I were running a new business, I would definitely be using EVA. If I was running a major business like UTSA or HEB, I would definitely be doing EVA. I think it's a great process. The CFO, the former CEO of Rackspace, before they were bought out, he was a big EVA user there as well. I might talk a little bit about his philosophy. It's a little bit different than the way I might think about it, but it's interesting. His approach, he thought it was an extremely important measure, and so it was an important function at Rackspace to make sure they were doing all the things they should be doing, and to assess what they were doing, if it was actually adding value or not. So that's the key. Management should be trying to maximize the value of the firm, and you maximize the value of the firm by maximizing economic value added. So let's bring this back to your CBA case, your cost-benefit analysis. There's a close tie here. If your net present value is positive, what that means is that's the same as saying the project has a positive EVA. If your net present value is greater than 0, then that must mean that your project's return on capital is higher than your firm's cost of capital. So they're one and the same. If you do positive net present value projects, you're adding value to the firm, and that means you have positive EVA. So these are all related to each other. We don't use the same jargon, but the jargon is slightly different, but the actual things that we're doing, the actual calculations, are very highly related. All right. Now, there's some debate. We might not get into this today. I'm just going to hit on it here. It's a debate you'll certainly see a lot, especially in College of Business these days, is should we really maximize value for shareholders? Aren't there other stakeholders? You have employees. You have customers, suppliers. You got the bondholders, where EVA does consider the bondholders. Remember, it's return on capital, not just return on equity capital. You got community and society at large. Well, part of the theory is if you're going to maximize the value for the shareholders, you cannot ignore employees and customers and suppliers. You've got to take them into consideration. If your customers are not happy, if your employees are not happy, you are not going to be adding value. And in fact, there's a really wonderful study that shows that the firms that are adding the most value to their shareholders also happen to be the firms whose employees are the most satisfied working there, whose customers are the most satisfied, their suppliers are the most satisfied. There's a very high correlation between firms that maximize shareholder value and firms that also take good care of everybody else. Now, in the community and society, there's a big debate today about global warming and CO2 emissions and those kind of things. So there is some debate. Should firms, do they have a greater responsibility to society at large? Obviously, a firm is a major polluter. It's going to make its employees and customers upset. But that's a big issue. You can certainly research this on Google just by talking about shareholders. You could probably just Google shareholders versus stakeholders, and all kinds of articles will come up. All right, so what we want to do is we want to talk about EVA, and we're going to get into it. I'm going to give you a definition. We are then going to work through a really simple solution example, then walk through a more difficult solution, and then we'll talk about the Excel application. I can't remember how many Excel applications I gave you. This is maybe the easiest one of all of them. And so once you get it set up in Excel, it's really easy to add a second problem. So we have GAAP earnings. GAAP earnings, that's the generally accepted accounting principles. That's the earnings that you used in your project 1. EVA says GAAP earnings are not a good measure of how good of a job management is doing. First, because they can be manipulated. And secondly, they don't fully reflect the cost of capital. So what we're trying to do is adjust GAAP to take it to an economic number. So we want to understand what's going on with this firm in an economic standpoint, because we know GAAP has some assumptions that may not truly reflect what's going on with the firm. So instead of using GAAP earnings, let's look at economic value added. So it's a more comprehensive approach. It focuses on economic value instead of accounting value. You might have a manager increases sales, and you say, well, that's great, but it might increase working capital. Remember, accounts receivable, inventories. It might increase risk. It might actually have a lower return on capital, because even though they're increasing sales and you're getting more income, it's a heavy capital requirement. You got a lot of property, plant, and equipment. You got to do a lot of investment and marketing projects and other things. So you might have a higher net income, but your income relative to the capital you deployed is not good. So we don't want to reward this manager, even though revenue's up, maybe income is up, but the firm is making less money on the amount of money that's invested in it. And so they're actually destroying value. So if you just focus on sales or accounting earnings, you could actually be destroying the value of the firm. So economic value added is an approach that tries to assess performance based on the value of the firm. And so you can express it in dollars. EVA can be non-operating profits after tax. We're going to use a slightly different approach. We're going to simplify it. This is a good formula for finance majors to learn, but I don't need the rest of y'all to learn it. Even finance majors, you'll see it in your corporate finance class. So you'll get back to this, trust me. So you're not operating. Essentially what we're trying to do is get economic earnings minus our cost of capital, all in dollars. That will give us our EVA. It's the same thing as return on invested capital minus the cost of capital, but all in dollars. We can do it also in percent, and I'm going to show on the Excel application you have to do it both as dollars and percents. So manager could significantly increase profits, but if it comes at a huge increase in capital, then the EVA will penalize them, and we'll find out if the manager's higher profits are really adding value to the firm. So we don't want managers seeking higher sales, higher profits. What we want them to do is seek higher economic value added. So not everybody can have a return on invested capital, but if you explain to everybody in the firm what the concept is, they can better understand that, hey, I want to increase earnings without increasing risk. Or if I do increase risk, increase capital requirements, I have to buy more machinery. I got to make sure that additional income covers all that additional capital requirement. All right, so what we'll do next session is we'll walk through our first example. I don't know why that's in the notes. You can just delete it from your notes. I forgot to delete it when I created notes for this class. So next session we'll start right here and do an EVA example, the one in the notes. Then we'll go to a more complicated one. This second example that's a little more complex, you're gonna see that it's very much like, well, the second one. The second one's down here. I'm sorry, on page 49. It's very much like your Excel application. In fact, it's really quite exactly the same. So it's just a matter of plugging in the numbers. So we'll leave it there, and in the next session we'll get into the examples.